We haven't been broadcasted live for 2 weeks. Many things happened since then. Lots of things have surprised us to the large extent. So I couldn't really wait more for that moment to hit that live button once again. And I'm very glad you decided to join me live today on our live video about the updates on the market. So as always, we have market outlook with macroeconomic view along with what happening on the market right now, what are the projections, and what the supply and demand side are telling us. And also some news about regulated market and ending up with some propositions of trade for the next session. So without any further ado, let's head on to first section. All right, so let's get over to economy view. Economy view is the section where I'm just putting up the most important macroeconomic standpoint that right now is playing first fiddles. Yesterday we had this CPI gauges that has eased. The annual inflation rate in the US slowed for a 9th consecutive period to 5% in March 2023. So we had, aside of it, food prices that grew at a slower rate, 8.5% versus 9.5% in February. Also, energy cost fell. That was expected, as we've seen that oil on the market along the natural gas has dropped significantly. So we had the drop in gasoline, drop in fuel oil, and compared to the previous month, the CPI edged 0.1% higher, also below the expectations of 0.2%. So we have CPIs lowering down, but still there's elevated, and compared to the previous month, CPI edged them, as I have mentioned, 0.1% higher below expectations. So that's right now a really very quite of a conundrum for the policymakers, where we have this on one side easing CPIs, but inflation rate is a bit higher than expected during that time, and that's causing a mishmash. That's why many of the indexes has reacted quite with a daunted type of a reaction, where those things of inflation are nagging many traders. Let's look at WTI. Recently, we've said, all right, so inflation is going downward, but WTI is right now building another wave of rise, so it may really head on this inflationary pressure persist for longer. OPEC Plus announced a surprise oil production cut that will exceed 1 million barrels a day. That was the news out of the beginning of April, and that wasn't a any kind of joke. This has caused a massive price action that's right now pushing oil prices forward. For this one, I would like to have a look into the market of oil and find out what's happening out there. But before that happens, just maybe approach this case a bit better. So as we can find on many journalists, media website, oil is sometimes pointed out as the one of the assets that may get to $100 price, and an earlier than expected worldwide supply demand deficit may push it forward. But for now, even though Saudi Arabia won't agree to increasing its supply, that's a little bit too few to consider that $100 for WTI should be quite achievable. Right now we are at the lower or higher. It's around 80, higher 80 and lower $90 territory, and it may give some assumptions that with that recent price action we may even go forward. But tensions between United States and Saudi Arabia are rising. That's why I guess United States won't really agree to this Saudi Arabia move and won't catch up to this step by decreasing supply even further. So right now let's head on to analysis of WTI to USD, and right now we can find that WTI is trying to get out of this horizontal line that has previously been a very important ceiling that was keeping the oil price for the recent 5 months. Right now it looks like there is a power to get out of it, maybe not in one move, as the market for WTI is quite extended, but I do expect that it may happen in a while, until any type of reversal may negate this recent candle spike. So right now WTI is unthreatened, and for me this area of 93 is still achievable this year. $100 is kind of a psychological level that may get hit, but for now it's very early to say that. However, out of the inflationary standpoint, I would find that that may even spark another possible panic among those that are afraid of the return of higher inflation if that scenario plays out. All right, so that was about WTI monetary flows. Just a few cents about this one, and it's the very new findings. The household sector throughout 10 to 12 years horizon during this loose monetary policy loses, and business sector in a longer time horizon also have some difficulties when this loose monetary policy is handling. So this loose monetary policy we've been going through and been dealing with throughout recent over 10 years can negatively impact the business sector in the long term by leading to inflation. And there is too much money in circulation, prices tend to rise, which can reduce the purchasing power of consumers and increase the cost of production for businesses. And that also can lead to the scenario where those companies may have difficulties with maintaining profitability, which can ultimately lead to decreased demand for the products or services. So that's why I do find that this monetary, very loose monetary policy not only has caused cracks on the system when those banks eventually started to demise, but also for the such a tiny for the global economy things as household sector and the one for the retail problems, it may add up to much more complicated outcomes that will eventually lead to much more eventualities alongside with the business sector producing zombie companies that can have negative effects on economy as they soak up capital that could be used by innovative companies and undermine investment. So that's the very new finding that you may also ponder about. Federal government current expenditures are going through the roof. The government is borrowing more money to finance its operations, which can lead to an increase in the national debt, and this can lead to higher interest rates, reduced investment, and slower economic growth. And unfortunately, this chart is nowhere here from stopping. Right now, overall rising federal government expenditures on interest payments can signal an unsustainable fiscal situation that and can have negative consequences for the economy in the long run. So that's a debt trap that we may all have to pay for it, where very often this debt crisis where liquidity support where liquidity will get a support will be unfortunately insufficient to resolve. Tightening conditions. So financial conditions have tightened due to stress in the banking sector that recently dumped lending to the real economy, reduced aggregate demand, and in turn inflationary pressure. So we've seen that this recent turmoil with banks poses a risk to the real economy, and central banks are relying on emergency liquidity and regulatory measures to deal with it. However, there is uncertainty over the true extent of the tightening in financial conditions. Those indices may not capture the likely tightening in lending standards. That's why you need to make a little. That's why this real chart might be a bit bended, a bit more curved. But anyway, the this overhaul picture looks should look as it is supposed. So right now, if financial conditions will ease more rapidly, this could be a reason for central banks to hike by even more than currently forecast and for rates to stay higher for longer. Short becoming long. That's a fun fact out of the Goldman Sachs that we find for marking 60 million short sales as long. And the Goldman Sachs did not admit or deny these findings, and $3 million fine will be split between FINRA and a number of stock exchanges. Goldman later improved its order tracking to prevent orders from being improperly marked, but right now it looks like whenever they are wrong, they are trying to tweak their data in order to make it their way. It's really outstanding, and it looks like the true facts are given and obtaining a really, really pesky narration. Right now, let's head on to Market Outlook, and in Market Outlook, let's look at shorts that are building on S&P 500. So emanating net shorts, most in several months. So it means that it's more likely to break to the upside. But if we just look at the another side of a coin, S&P 500 mini indicates that the position that are building right now to the upside are those small speculators. So it means that when those leveraged funds are dropping, small speculators are coming in, and it means that if it gives a trade-off, and when they offsetting together, it means that in that scenario, that wouldn't really spark any type of very high type of move. So for now, that's more like a blurry outlook, and that's the one thing that we may watch in the future and observe very carefully. What about equity sentiment? So recently, it's in a not very good resolution, but I just want to tell you, as I don't have the access to this picture right now. So what it depicts is in 2023, this line that symbolizes the recent move, sell-side indicator, is closing a bit, is approaching a bit closer to this buy threshold. So it means that we still have a room to run in terms of a longer time horizon. What about crypto outlook? Right now, let's head on to cryptos. So crypto tourists are gone. That's what our metrics say. That there has been a drop in liquidity in cryptocurrency space, that have been afraid of those market turbulences recently with banks and previously with Terra Luna and FTX both. So right now it's still very shallow market, so it means it's much easier to push the price higher from here. So there are not many retails, and even if there are retails, the investors out of the institutions haven't yet catch up that the data shows. So this means that large orders can easily move the BTC prices, resulting in more wide swings in the market. So it's positive, but also negative in terms of a volatility that it may spark. The Shanghai fork is already through. So Shanghai fork was this fork on Ethereum, the second largest cryptocurrency, that was about to bring over the new supply side in terms of the amount of tokens that were about to be unlocked. But right now it looks like that the majority of the market is wrong about if, and the price is still going higher. So the aim of the market is to for the highest amount of market participants, and that's what happened this time. Everyone was started to sell, or the majority started to sell on the news of this Shanghai fork happening. But not only that Shanghai fork has happened successfully, but also the price of the Ethereum is still rising to surprise of many. Just look at the price for Ethereum, and it looks like Ethereum don't give a yes, you know what. So right now we are approaching a possible ceiling of a price at 2030, and it may stop this crypto for a while, but it looks like we are at a very nice trajectory that only longer time horizon should get us to around 2500s. But right now, this ceiling is the one that we need to respect. All right, so that's Ethereum, and to look at due to a recent successful fork, you may claim also some tokens out of the airdrop have been prepared by Consensus. So it's a airdrop with NFTs. The objective of creating this NFT hasn't been yet announced, but if it's free money, you may claim it if you are just really into this type of free digital collections. All right, let's look at market movers and what's in it. So in market movers, looks like profit margin estimates are sliding as costs remain high, and we are approaching an earnings season. And although inflation started cooling from historic highs, we still find it this high costs of labor and raw materials may prompt this indexes lower with on the wave of this negativity of earnings, possible negative earnings. But right now, everyone is bearish about the earnings, so it's much more easier about surprise to the upside. But we need to take care of that indexes are already high in terms of valuations. That's why this surprise need to be very, very significant in order to push it upwards much more remarkably. Right here, we have also rate sensitive industries that I wanted to put out that right as an of average level of activity is dropping on many rate sensitive industries, while insensitive industries lag behind. In terms of momentum, also many of the industries are interest rates sensitive, and that's why we can find that many of them are lagging. But with a fading of this hiking interest rate cycle, we may eventually get back to this much bigger positivity than we were experiencing lately. In terms of trade idea, but sorry, I have switched already scared these elements of economic calendar that I wanted to go through this this moment. And for this week, you have Westpac consumer confidence that was higher than expected. On Tuesday, we had Fed Kashkari speech that have expected that that the interest rate hike will be still intact on May. On Wednesday, however, we have had inflation rate year over year out of US that was lower than expected, so it was positive. However, core inflation rate was higher than the forecast, and the Fed looks a bit more into a core inflation rate rather than the inflation rate per se. Bank of Canada monetary policy report, FOMC minutes, balance of trade. I wanted to mention as well GDP out of UK that's right now at a neutral level, and PPIs out of US at negative. That was today been published. So a PPI right now is bringing some of a much more negativity for the economy right here. So economy is slowing down. That's why the Fed should possibly slow down with its hiking interest rates. Projections. Retail sales are tomorrow to be announced, and Michigan consumer sentiment as well. In terms of earnings calendar, we have so we haven't had yet any significant data, but tomorrow is approaching a very important data out of the banking system. JP Morgan Chase, Wells Fargo, BlackRock, Citigroup, that will and United Health Group Incorporated, they will have given us an outlook for what's happening underneath the economy. In terms of finally trade idea, let's find out. And I have for you much very interesting and highly volatile index of US 100. So US 100 right now is trading at below the supply levels of volume profile of highest volume profile since latest 15 days, and that's where it will be very difficult for the index to get through. Right now we do expect that US 100 will revert out of this area of 12.950, and the possible trajectory of a price for this will be like that. Also, it doesn't go it won't go with straight line as I have drawn it, but you need to be aware that this type of trajectory is determined by that we have a very sharp gap to be closed within next few sessions, as we already have closed this gap. Another one is waiting in a queue, and that's what may happen tomorrow or on Monday. I don't expect that it may happen today, but tomorrow or Monday will be that possibly the day. So anywhere within this blue box, I do find that US 100 should be fine to bet a short position from there, and you have possibly 2.58% with a quite adjustable panel of a possible trade to take. So it's at around 2.3%. I would adjust the bottom line at around those levels, just below the gap that I have just mentioned. So that will be a quite comfy type of a trade, and you may consider this by yourself. So this is where I do find an opportunity right now. As yesterday we have hit a ceiling of a supply zone, we have searched for liquidity, and we found it. That's why we rebounded out of it, and right now we are slightly moving lower. So sorry, I haven't switched the window right now. That's how US 100 looks like, and as you can find right here, there was a ceiling being set on Wednesday. Yesterday at yesterday's session during this CPI spike, we have rebounded out of the ceiling. Right now, we are correcting that move, and after that rebound, there is a more likely to move lower, especially with this volume profile right here, giving us the territory that will be very difficult for US 100 to cross through. So that's why I do expect this 2.26% to of a 2 of a profit to grab within next few sessions. So US 100 right now should slide lower, and that's why I would expect that next week US 100 will be traded within this area of 12.61 and 70, and not above 80. So that's it in today's episode. Thank you very much for watching. Remember about risk management, and I'm very glad you decided to turn it on. So tomorrow at 8:45 a.m. each time, we'll be back with new dose of updates regarding the market, stocks and cryptos as well. So thank you and bye.